We were anticipating such an event probably late February, early March. But now the game's changed. They moved it up. Okay, fine. We still think that's probably your midpoint stumble. That's not the end of this move. Again, we've got too many metrics that are massive in years. Gold versus S&P, silver S&P, silver versus gold. All these things just occurred in November. You don't break out of a decade-wide base and go for 2 months and say, oh, that was it. Third month of the 6 month or so surge, it occurred at the end of the second month, earlier than we expected. So we were wrong in that regard. And it was deeper than we expected. But frankly, when we look at the depth of that sell-off, which got down to 71, 72, on Monday, first day of this month. So we had like a day and a half collapse, really. It was all a day and a half, the whole drop, day and a half. We dropped back to the rising 3-month average on silver, a level it has not seen since the first half of last year. So to return to a rising average that is now acted like support. Sometimes you have to return to the mean, 3-month average isn't super long term, but it returned there and it tested it again today. So anyway, we view the pullback as being a very sharp but non-event in terms of changing our outlook. We still think silver is in a rampage. This is what you would call the midpoint stumble. And what we expect this month to see is silver firm again in February, probably not see a new high this month. In which the January high stands, okay? True for gold and silver. But we see a firming action such that by the end of the month, we're well back up off this low and somewhat approaching the January high. It's in March that I would expect that if after we see that stability action this month, that you then resume. And March says, okay, game on again. And then, again, if we're correct in our analysis, and we have multiple reasons for coming up with this observation of the 6-month surge, it's not just that one thing, you could see silver reach into the several $100 zone, like $300 to $500. And that sounds ludicrous, I know. If you want the explanation as to why that's sort of a target, I can give it to you.
The silence following a market crash is often louder than the roar of the rally that preceded it. In early February 2026, the silver market sits in a state of slow price movement. Having surged to a localized peak of $120, the metal has just endured a violent 30% retracement, finding support in the low 70s before stabilizing near $76. To the unseasoned observer, this volatility signals the end of a mania. To structural analyst and momentum analyst Michael Oliver, this is merely a midpoint stumble in a historic rampage. The tension in the market is palpable. The overwhelming mood often shifts rapidly from euphoria to the conviction that silver had peaked and we missed it. Yet this ignores the structural reality. The $50 level, once the impassable ceiling for half a century, what Oliver terms the idiot highs, has been definitively shattered. The market is no longer confined by the boundaries of the last 5 decades. Yet most participants are misinterpreting the current price action. They view the drop from $120 to $71 as a trend reversal. Michael Oliver, however, argues that this sell-off is a necessary shin kick designed to clear sentiment before the next leg higher. The momentum structures, specifically the spread relationship between silver and gold, broke out of a 10-year wide structure in November 2025. A breakout of that magnitude does not resolve itself in 2 months. It is a signal of a multi-quarter, if not multi-year, acceleration. While silver pauses to catch its breath, other asset classes are signaling a broader regime change. Bitcoin, once the darling of speculative liquidity, is now described by Oliver as a broken asset, having violated long-term momentum structures that suggest a deep, prolonged bear market. Price targets in this framework are not predictions, they are outcomes derived from structure. Oliver stated that within the current 6-month advance, silver could experience a vertical phase that could take the metal to anywhere between $300 and $500 an ounce. This price prediction is grounded in prior percentage moves, multi-year supply deficit, and in silver's historical relationship to gold during monetary repricing. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Make sure to check out our other videos on the silver market and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
Two views of reality that are simply price. Okay, if you get a price chart of silver monthly, go back to 75, you'll see that it lived in this half-century zone of reality. $50 to $4, $50 to $4. So it's about a $45 range. Okay, you add 45 to 50, the arithmetic swing objective of a box like that on a price chart. You take the distance of it and you add it to the top. It says target 95, maybe $100. Okay, what happened back then a couple months ago? You stumbled in the mid 90s. It was repeated selling, 93, 95. Okay, guys saying, hey, we reached our objective on orthodox methodology. If you take a logarithmic or ratio scale chart of silver, same time period, you'll see that that range from 4 to 50 was like a tenfold dimension. If you bought the bottom of that range and went to the top, it's tenfold from where you bought it to the top. And it went back down, up and down, for 50 years. Okay, tenfold on top of 50 is what? Okay?
Gotcha.
Okay, 500. Okay, now you will take a gold chart, do the same thing back to 75. It's had bull moves that blow out the prior high. On a ratio scale chart of gold, not arithmetic, but ratio, you'll see that both of the prior bull markets, the 1980 peak, the 2011 peak, were 8-fold gains, bear low to bull high. Silver was still capped at $50, but gold wasn't capped at each peak. It was an 8-fold gain from bear low to bull high. If we have another 8-fold gain, which is merely matching the dimensions of the prior two bull markets, 1980 peak, 2011 peak, you'll go to $8,500.
That's based on the 1050 in December 15.
Yeah, I've put it in a lot of reports, but that's merely replicating an old reality you've done twice in gold. Eightfold. Big deal. You do it again. Look at the conditions out there, the factors in play, the bond market problems, the Forex problems, commodities asserting themselves again, a new commodity bull, inflation, as many people like to define it. Gold's going to top with a 5-fold gain. Okay. So even if we just match that, and by the way, we coming up with that number months and months ago, JP Morgan just came out with the same number, 8,000 to 8,500. We find that curious. But even that's not our target. But in the case of silver, if you do the ratio scale of its dimension, you come up with 500. And if you factor in M2, and I haven't done it, but a lot of people have, you come up with several $100s just to match the 1980 high or the 2011 high when you factor in the decay in the money unit, the real buying power, the quantification of the money supply. Silver, to get back to those realities, would be well in the several hundreds. So we keep coming up with numbers that say, hey, and we looked at copper and lead back in the 2005 and 2007 for lead. They broke out of a similar range, and when they broke out, literally in a couple of quarters, they quadrupled in price on their own without help from other markets. They went into a new reality. How come silver was caught in that reality for 50 years? Something smells there. Okay. Well, it's saying no more. Okay. And it has yet to achieve anything remotely close to what even copper and lead did, or to what gold has done over the last 50 years. I think it's about to. The momentum trend, first of all, the price trend was obviously up as well. Okay. And we were challenging and finally nipped out those $50, what I call idiot highs, because they lasted for a half a century, $50, $4, et cetera, back and forth, confined like no other market on the planet almost. Gold wasn't confined during 50 years, neither was copper. Okay. Anyway, so at the time of that conference, $48. What are we now? We're trading right now as we speak, 76. So, oh, terrible. Okay. Percent wise, it's a huge gain. Yes, we're well off the high we just saw last month. But at that time, a couple things had already happened. One, we look at the trend of silver and gold in long-term momentum metrics. Like, for example, we measure the monthly price action of silver gold in relation to, let's say, a 3-year average or a 3-quarter average. These are fairly long-term yardsticks. And we don't just overlay the average. That's not meaningful. Sometimes you can cross those averages and who cares? Okay. It's when you plot the bars of price in their relationship to a given moving average. Like, is it above it or below it? Okay. And if so, what's the high of the month, low of the month, close of the month in relation to that given moving average? And those averages change, of course, every month on a 36-month, every quarter on a 3-quarter average. But anyway, you get a different chart when you plot momentum in bar chart form against certain long-term averages. And you see trend structures, the kind of things that an average price chart guy would, like, he'd draw a line across a couple highs and say, oh, we broke out over that line. Or a floor that you've used 2-3 times and you break below it, therefore it's all over, it's going down, that kind of thing. We do it with momentum. Almost always, when there's a trend shift, even short-term, intermediate or long-term, momentum usually will break its structure and indicate the new direction prior to price smacking you in the face and saying, oops, I'm going down or I'm going up. Okay. So it's a good leading indicator, and you can anticipate trend changes, especially when you see on momentum a structure that just is so clear and used so many times as resistance or as support. And usually they don't last forever. I mean, you can only use a certain level so many times, and finally, if you hit it too many times, you go through. Okay, that's true with momentum. Anyway, at that point in time, silver on our long-term momentum metrics was already fully positive. In fact, one of our primary entry points was before that, was back in, if you recall, silver was capped in a range with a high above 35 in late 24 and a high above 35 again in March of 25. There was like a year there where it twisted and turned at that level and to the downside, a congestion zone, but very wide. The third time that it came back up toward that 34, 35 level was back in June of last year. Silver still in the mid-30s, still in that range, but momentum said, you're breaking out. Price had not yet broken out. That would have required getting up to 35.50 to blow out those 2 prior highs on the price chart. But as it approached 35, that third time, our momentum broke out, and we said, okay, acceleration phase for silver now commencing, meaning rather than this 2 steps forward, 1 step back process, it's going to be like 5 steps forward, 1 step back. Okay. And boom. Later in the year, we're at the $50 level plus. Okay. Challenging the old idiot highs. But then something else happened. And that was in November, a month after our conference in Toronto. At that point in time, nothing had changed on the silver price or long-term momentum positives. They were positive already. No big deal. But why is it all of a sudden, after the November close, which I think was in the 70s or something like that, silver broke out versus gold, where when you plot the spread chart relationship between an ounce of silver into an ounce of gold, you go back 50 years, you can do that. You'll find that back in the 1980 bull surge in silver was 6.5%, divide an ounce of silver, an ounce of gold, of the price of gold. Okay, keep that in mind. And then it dropped back down. And then in that same 50-year price range, in the second surge in that range, which peaked in 2011 at $50, silver versus gold reached up to 3.1%. Okay. Early last year, silver, you gush through that, you gush. And you usually gush for a couple quarters. And yes, in the middle of each of those surges, there is a shin kick that, oh gosh, it's all over. This one came a little sooner than we expected. We were frankly expecting a midpoint stumble late this month or early March. Instead of being like in the third month of the 6 month or so surge, it occurred at the end of the second month, earlier than we expected. So we were wrong in that regard. And it was deeper than we expected. But frankly, when we look at the depth of that sell-off, which got down to 71, 72, on Monday, first day of this month. So we had like a day and a half collapse, really. It was all a day and a half, the whole drop, a day and a half. We dropped back to the rising 3-month average on silver, a level it has not seen since the first half of last year. So to return to a rising average that is now acted like support. Sometimes you have to return to the mean, 3-month average isn't super long-term, but it returned there and it tested it again today. So anyway, we view the pullback as being a very sharp but non-event in terms of changing our outlook. We still think silver is in a rampage. This is what you would call the midpoint stumble. And what we expect this month to see is silver firm again in February, probably not see a new high this month. In other words, the January high stands, okay? True for gold and silver. But we see a firming action such that by the end of the month, we're well back up off this low and somewhat approaching the January high. It's in March that I would expect that if after we see that stability action this month, that you then resume. And March says, okay, game on again. And then, again, if we're correct in our analysis, and we have multiple reasons for coming up with this observation of the 6-month surge, it's not just the one thing, you could see silver reach into the several $100 zone, like 300 to 500. And that sounds ludicrous, I know. If you want the explanation as to why that's sort of a target, I can give it to you.
Conversely, the Bloomberg Commodity Index has broken its own dormancy, with oil and agricultural staples joining the monetary metals in a unified move higher. This is not isolated volatility. It is the repricing of all real assets against a failing currency. The outlook for the coming weeks is one of stabilization. The frenetic energy of the initial surge is expected to give way to a firming action throughout February. This period of consolidation is deceptive. It is the calm before the resumption of the trend. Oliver's analysis suggests that by March, the game is on again, with targets that seem ludicrous to the conventional mind, $300 to $500 per ounce, becoming mathematical probabilities based on historical ratios. Let's get back to the rest of the interview.
If you drop down to a more intermediate timescale, because again, I said quarterly and annual momentum, there's not any structure that's anywhere nearby to say, oh gosh, I broke it, it's over. Okay, it just doesn't exist.
That's the long term.
Okay, that's long term. Drop down to intermediate, and intermediate would be monthly. Month to month versus a 3-month moving average, okay? Usually when you get trend swings on that metric, on the oscillators, you'll see they run for 4 to 6 months, okay? That is if you break a structure. Now, this recent pullback, instead of breaking anything, it came down to an average, the 3-month average on gold and silver, that it hadn't seen for silver, for example, since before last summer. So all these months of rising silver, you never even condescended to pull back and touch your rapidly rising 3-month moving average, like the zero line on the oscillator. You hadn't even come down to it. So finally, we touched it early this month, the first day of this month, when we had a slight further follow through to the collapse last month. You touched the 3-month average almost precisely. And you rallied $20 off of it. Now you came back and retested today. It's not structurally important. It's just an interesting fact that you haven't even returned to a balance point, a zero line. the 3-month average. And it's likely we'll find support there. Gold did the same thing. Gold broke it by, I think, about $50 and immediately exploded. So that's what I think we just saw. And it was merely a return, even on intermediate stuff. It said, hey, this might be a place to buy. Now, when we shrink down to weekly and go to like a 3-week average, we blew a structure on weekly on Friday a week ago. And sure enough, instead of a nice sell-off, you had a huge sell-off. We've broken that same structure before on weeklies and only had a, so-so sell-off. This time it happened to be big. This week's high rallied back up to the 3-week average, which changed from last week, obviously, and bumped our head on it. So on the oscillator, you broke through the zero line, and this week you came back up and bumped it. So what had been prior lows, now, boom, you bumped it. You set that level. So next week, with a now falling 3-week average, if you get back above it, the weekly momentum, which had a stumble and broke a minor structure, you'll reassert yourself back above the structure saying, okay, game over, I'm back up again. And all it takes is getting back up into the upper 80s anytime next week on silver. We'll do that. So, but again, that's short term. So looking for a midpoint stumble in our couple quarter surge that we expected to have a couple quarters of massive surge. Back in 79 when that occurred, again within that old $50 range though, and in 2010-11 that occurred. About in the middle of that clock, one was a 5-month surge, one was a 7-month surge. About in the middle, there was a bad month. In the case of 79, it didn't actually close down, but you had a stumble that for about 6 weeks, you could have gone sideways after you stumbled. Okay, so it didn't go anywhere. And in January 2011, you had a massive monthly reversal on a price chart where a price guy said, that's a key reversal month, it's over, okay? The next month, worked your way back up. And what happened on the other side, once you cleared that high, was more massive than what had happened up to that point. So it was a massive move interrupted by a midpoint stumble. We thought that likely would occur more likely, let's say, get into 3 months into the possible couple quarters. Instead, it happened after month 2. So we were a bit surprised by the quickness of it. No, we did not call it. We were anticipating such an event probably late February, early March. But now the game's changed. They moved it up. Okay, fine. We still think that's probably your midpoint stumble. That's not the end of this move. Again, we've got too many metrics that are massive in years. Gold versus S&P, silver S&P, silver versus gold. All these things just occurred in November. You don't break out of a decade-wide base and go for 2 months and say, oh, that was it. Oh, yeah. But in this case, I think this is an investment grade move in the monetary metals that you shouldn't trade.
Okay.
We've been saying all along that there have been many over the last year, 10 and 15% drops in silver that happened like overnight. Okay, now this was bigger, okay, admittedly, but they happened very quickly. Used to be they'd take several weeks to recoup or a month or two. Now they're occurring rapidly. Look at the October stumble we had, for example. There was a sharp sell-off in October that I think was like a 15 or more % drop. It took a couple weeks to get out above that. So I don't think this stumble is going to last very long. And the problem with exiting prematurely, even in a thing like this, is when do you get back in? Do you get back in? When do you get back in? And is it better than where you got out? Or if you don't get back in fully, what's on the other side of this is highly likely to be far more gain for you, had you not wiggled, than what has already occurred by our assessments. We think what's on the other side of this is far greater than what's already occurred. So you have to think about it as an investor. Are you in this for the jiggles, even the sharp ones, to avoid? Are you in this on an investment grade? And we're arguing you don't have to wait for years on this either. highly likely that much of what we're going to get this year will be achieved by summer.
The shift is absolute. The idiot highs are in the rearview mirror, and the volatility we witness today is simply the market adjusting to a new altitude. For those watching the momentum rather than the price, the direction is clear, and the destination is inevitable. History does not repeat mechanically, but it does rhyme structurally. And in every prior instance where sovereign debt stress forced monetary expansion, silver did not lead the cycle, it finished it. That's all we have for today. Please make sure to like, share, and subscribe, and we'll see you all in the next video.